Welcome back. Bill, a slew of companies continuing to announce special dividends so far ahead of the fiscal cliff, making these moves in anticipation of higher taxes in the new year. The list goes on and on. In total, it adds up to more than $21 billion in payouts.
So will these types of actions accelerate it if a deal is not reached anytime soon? Plus, is there a downside for investors here? With us today to talk about it, Steve Nemeth from Sun America Asset Management, Brad Rokoff from Barclays, and our own Bob Pisani joins us as well. Steve, what do you think? I mean, everybody's rushing to declare these special dividends. I'm going to turn on because you're sitting over here.
Yeah.
They're rushing to declare these special dividends, and there are those investors who would find them attractive right now for tax reasons. But are they good in the scheme of things?
I think they're good because the stocks, the companies that have announced these special one-time dividends have gone up a lot. So investors have been getting a lot of research from the sell side only over the last 2 weeks, looking for those new ideas. A lot have already happened, but there are some really significant opportunities out there in certain names. So we own Dish Networks, for example. It's about a $16 billion market cap company. They have $5 billion in cash. 3 of the last 5 years, they've paid a December special dividend. And the owner of the company, the founder, Charlie Ergen, I believe, owns 55%. He can save $500 million in taxes on the dividend alone if they were to announce a $5 billion dollar special dividend in the next few weeks.
So you, as an investor, you want that special dividend now. You don't think it takes away anything from 2013?
But not at all, because I've been on the show over the last year talking about all these great balance sheets and how investors will at some point give them value. They have not gotten any benefit from these great balance sheets. So I think when those special dividends are paid, which investors get, I don't think the stocks go down. So it's a net benefit.
Brad, what do you think?
Yeah, I mean, look, I love to be the conservative credit guy and say no way these companies should be adding leverage, increasing debt balances.
Go ahead, please.
But honestly, you can't blame them with where rates are right now and where rates are to issue corporate debt. I mean, you look at some of the levels that even, we have aggressive issuance, you'd call it this type of use of proceeds, and they're still, barely paying. You see Costco's deal was inside of 2% on all of the tranches of debt. And companies are adding leverage, but they're not adding enough to really make a difference for credit investors. They still want to buy this debt.
Bob Pisani, what do you make of what's going on the floor today? And germane to what we're talking about here as far as these dividends go, are these companies outperforming right now?
The short term, yes. I'll tell you what the problem with this whole dividend story is. It's been very difficult to actually pick the companies and get them right. It's only really been a small handful, particularly the ones that have moved it from January to December. Walmart's the big one, but there haven't been an awful lot of others. But they may not have to. Here's the good news, Bill. There's a drop dead date. The people I talk to say it's about December 17th. If we get nothing happening by December 17th, there's going to be a flood of companies that are either going to do special dividends or move the dividend forward from January into December. You're not going to have to pick it. You're just going to see it move forward here. And I think that's the good neuse.
We're running the list of companies. It looks like a K-Tel commercial right now.
Yeah.
Right?
But in the universe of stocks, it's still not an enormous number.
What's the downside risk here, Steve? I mean, I know you've been a guy who owns dividend payers for a long time, but here we are on the edge of this fiscal cliff. A lot of people say that if we go over it, we're going to see dividend taxes go to 44% next year. So do I really want a special dividend now if in a few weeks or in a month it's going to be an issue for me because I've got a 44% tax bill?
You know what? I think you buy dividend stocks here. Based on everything I'm reading, it seems like the White House, the Democrats, are willing to give up the high dividend tax rate to get something. It seems like that's the first thing they're going to be flexible on. So maybe the rate goes 20 to 25%. I don't think you see high 40s.
You're willing to bet on that right now?
Oh, yeah.
Wait, that's capital gains. 15% is dividends, right?
Dividends.
Yeah, so you think where does that go?
Well, I think the dividend tax rates, some people believe it'll go up significantly. I think the White House, at least on dividend gains, is going to be very flexible there. I don't think you see the rate go higher than 25%, which would be a worst case scenario.
And if that happens, I think you'll probably not see a flood of companies move those dividends forward. If it's 43%, you'll see a flood going from January to December. If it's 20%, I don't think so.
We just are showing you that the markets are moving higher here. We were talking about the bias to the upside toward the close here.
And Bill, how worse headlines can you get, Bill, than John Boehner, the Speaker of the House, saying we've gone nowhere on talks and the market has not fallen apart? If you're bullish, that's a very good sign. They still believe there's a deal coming.
Yeah. Well, I don't know that it's necessarily because of a deal expectation as much as it's because of this Morgan Stanley index rebalance and this movement toward the upside at the end. I don't know if this is technical in nature or more that they believe a deal is coming.
Today, I think it is. I think it's more technical.
It's technical in nature.
Before we go, Brad, what would you buy right now?
Yeah, I mean, I think from a credit standpoint, we're comfortable with a lot of these companies that you're hearing, could potentially come with a special dividend. If they're still a highly rated company that's a modest one-time uptick in leverage, we're still comfortable with that. I think the question really is if it's actually a change in the way a company is going to run itself from a leverage standpoint. We saw that with AT&T. That was an underperformer in credit. So if it's a one-time thing, I think we're comfortable with it from a credit standpoint. But if it's a real change in philosophy, that's when you'll see underperformance on the credit side.
All right. Gentlemen, thank you all. Good to see you. Steve, thanks for joining us today. Appreciate it very much.
Gentlemen.